Hello everyone, welcome back to Luxury Pro. I'm Pallavi Sehgal and today we're going to talk about the resilience of the luxury sector and especially given the current economic conditions. Let's start by talking about the financial results of the major luxury groups. And let's start with LVMH. Now, LVMH's third quarter revenues rose by 20% to 19.3 billion. The group's profit center, that is Louis Vuitton, grew 22%. The group says that demand for its products is holding up amongst the Americans, but simply shifting to Europe because the long haul travel has resumed. The company is still rebounding from the impact of China's strict pandemic measures, and it says that the results are better than the second quarter ones, but the footfall is nowhere near that was there in 2019. Moving on to Hermes, the sales for the 3 months ending September came to $3.7 billion, and this is up 24.3%, which is approximately double of the analyst expectations of a 12% growth. Echoing the upbeat comments by LVMH, Hermes also brushed off concerns that the industry's post-pandemic boom could be cooling off due to a looming recession. US shoppers mainly took advantage of the dollar's strength in Europe, and China for Hermes has rebounded sharply. Hermes has also flagged plans to hike prices by 5 to 10% in 2023 based on the rising cost and currency fluctuations. Now, this is much more than Hermes has done in the past. The company so far has been very conservative, much more conservative than its peers, which have aggressively raised prices during the pandemic. In another sign of confidence, Hermes said that it would accelerate a hiring drive in the second half after it added approximately 800 people in the first half of the year and increased salaries for all European employees in July. Moving on to Kering, Kering said that the third quarter sales increased by 14%, driven by a strong showing in Europe, although the revenues of its star label, that is Gucci, lagged the overall growth. The 14% increase was better than the analyst consensus of a 12% rise. Sales at Gucci, however, rose by only 9%, which is below a consensus forecast of the 11% growth. Gucci, which accounts for bulk of the profits at Kering, has been under market scrutiny in the recent months because after years of stellar growth, its sales have underperformed those of rivals like Louis Vuitton and Hermes. So, what are the key takeaways? Is luxury really that resilient? Well, certainly it seems so for the major groups. Luxury brands have managed to grow in the recent quarters with little support from its key Chinese market, where the return of the strict coronavirus lockdowns have hurt the sales. Even if the overall luxury sales do slow down, some of the luxury's biggest brands are positioned to outperform. Hermes, which is generally regarded as the sector's most insulated player because of the long-standing shortage of the Kelly and the Birkin bags, the demand for which exceeds production almost every time. And if we see all the luxury groups and the luxury industry as a whole, we feel that Kering's situation might actually reflect the wider luxury market than the likes of Hermes and LVMH. Most brands had joined Kering to meet the rebounding demand since the waning of the pandemic. So Kering Group's performance in future might be a better indicator of the performance of the overall luxury sector. This is what we feel is going to be how the luxury sector performs. Let's see how it actually goes.